Welcome to Stock Talk with Nico Criticos. Today we're going to take a look at Wendys stock, ticker WEN. This video is dedicated to Ryan Fischer, the one and only, and we're going to start by taking a look at some news that came out. So last time I made a video on Wendys was at least a year ago, if not longer, and I remember talking about the fact that they were coming out with about 700 of these ghost kitchens, and that looked something like this. Well, this article is from August of 2022, and it talks about how they are kind of scaling back that plan. I don't know if you want to say it backfired on them, but they definitely are cutting down. So now, as of last summer, they were only going to do 100 versus the 700 they planned for before. The next piece of news is that a hedge fund invested about $41 million, this hedge fund right here, into Wendys. And this article is from today. So you can look at that as a positive for the stock. I don't always like to put too much weight on that because these companies make mistakes all the time. And then finally, the big news is that Wendys is doubling their dividend. So in the past, it looks like they were doing about a dividend of 12 cents per a quarterly dividend of 12 cents per share. Now that's going to be 25 cents. And we're going to get into the more in depth about that in a little bit. If we take a look at their revenue here, what we're going to see, so that this is a $21 stock and the market cap is $4.6 billion on this. The revenue for this company, I would not call this strong revenue growth. So in the most recent year, we're looking at $0.9 billion of revenue. That was less than what they were doing in 1986. So they seem to be struggling there. It looks like they had their best year in 2009, and since then it's been pretty much downhill. So we'll see what happens with that. If we look at net income, we're going to see it's not great, but it's a little bit better because for a long time they were losing money or barely making a profit. So now that's a little bit better, and we're starting to see them put up better numbers. They did $177 million of net income last year. So that will get a yes, but the revenue will get a no. If we're looking at price to earnings, what we're going to see is that on average, it trades at about a 25 times earnings. It's gone as low as 6 and as high as 53, but I would say 25 is probably the fair range for this stock. If we look at what analysts have been doing for EPS, we're looking at about $1 of EPS for this year and next year. So I would expect it to be around $1, for the next 12 months. And $22 share price divided by $1 of EPS puts it at a 21 or 22 price to earnings, which means we're pretty much in that fair range where it normally trades, probably maybe even a little bit slightly lower. So it's not a bad time to buy as long as all the other metrics are in place. If we go to number 4, I would not call this company innovative. The ghost kitchens was one of the things they had going for them, and that just kind of backfired. I wouldn't really say they have a moat. I don't see, if we're comparing them to McDonald's, Burger King, or any other fast food restaurant, I don't see them having too much of a moat in comparison to others. The industry is growing. Fast food's growing at an expected 5% per year. Return on invested capital, I gave a yes on this just because I wanted to be nice. But if you actually look at the numbers, they barely pull this off. 7% last year, 8% the year prior, 6%, 6%, 8%, 7%. So they do put up 7% plus for a couple years, but there's a couple years here of 6%. So not the strongest numbers, but not horrible. Growing equity, no. The numbers are not great here. So if we look at the last couple of years, it's gone from 516 million to today it's 437. And that's a decrease after, we're talking over 3 years ago, it's decreased now. So that's not too good. That's going to get a no. If we look at equity, is it 15% of the market cap? No, it's a little bit less because I think it's around, it's more like 10%. It's a $4.6 billion company, and they only have 430 million in equity. Share count decrease, yes, this is something good they do have going for them. As you can see here, over the last couple of years, they've managed to do 2, 3, 4, 5% decrease in the share count, and it seems to have slowed the last 6 or 7 years, but it still has a good trend. So that's going to get a check. Then we're going to look at its balance sheet once again, and we are going to see that no, the assets are not anywhere close to being twice the number of liabilities. That will get a no. Profit margin over 10%. This is another one where when we look at this, we're going to see, first of all, this chart is hard to read because this number throws it off. I don't know how they had 500% profit margins then, but in the last decade, we see 6, 9, 9, 16, 29, 8, 7, 11, and 17. So there's plenty of years there where they're doing over 10% profit margins, so that will get a check. Then their cash is more than the average annual income. We're looking at about 100. We're looking at about 150, maybe $200 million is their average annual income. If we look at their cash right now, we are looking at $730 million. So that's more than 3 times their average income. That will get a check. Healthy dividend. Now this gets to the interesting part. As of right now, their dividend, it says it's 3%, right? The payout ratio here says it's about 60 something percent, 61%, right? Well, so this is saying, okay, this is interesting. This is saying at that 5%, close to that 5% dividend yield, it's a 61% payout ratio. This is still saying it's a 3% dividend. So this number is probably lagging. So we are going to go with this. So prior to this, I thought that 61% was before you double that dividend yield. But if they're already doing that 25-cent dividend every quarter, then that's a healthy number. If we look at the actual cash flow, though, what you're going to see here is that they are doing around $50 to $100 of, so net income, $100 to $200 million of net income each year. Then for dividends, we're looking at around 65 to 100. So that's, we're talking 50 to up. Yeah, we're talking 50 to 100% is going to dividends. So that makes sense. That's why that number is 60%. So I guess that's fine. That's a strong dividend, and that payout ratio is under 75%, so that'll get a check. And the company is originated in 1969, so that will also get a check. So we're looking at a score of 9 out of 14. Unfortunately, what's holding this company back, or this stock back as being a smart investment move, is its balance sheet. It has too many liabilities, not enough assets, and it's not growing revenue how it should be for a company like this. Therefore, I would not consider this stock a buy, but that's all for today. So thank you for watching, and I will see you next time.